Is Jerry Van Koolbergen. I'm a managing director responsible for the U.S. structured credit team at DBRS Morningstar. I'm joined by my colleague, Lisa Kwasnowski. Lisa, do you want to introduce yourself?
Sure. Lisa Kwasnowski. I'm a senior vice president on the financial institutions team, covering asset managers and funds, and also responsible for methodology development.
So investment fund debt is an emerging asset class that's been a useful tool for fund managers over the past few years. Fund assets are growing, and DBRS is seeing an increase in inquiries to rate fund-related structures. The investor search for yield, given the low interest rate environment, has driven increased demand for funds, and rating-sensitive investors such as insurance companies, asset managers, and banks have driven, in turn, requests from DBRS Morningstar to rate investment fund debt. The credit rating analysis for this kind of debt is unique, and it typically combines elements of corporate analysis and structured finance analysis. For example, for funds that invest in middle market loans, the analysis typically involves aspects of CLO-like portfolio analysis and an assessment of the portfolio manager. During today's session, we expect we're going to discuss the DBRS Morningstar Relevant Credit Rating Methodology, which is called the Global Methodology for Rating Secured Debt issued by funds. The current methodology focuses on corporate debt funds with a particular emphasis on direct lending, and we'll also share our views on the credit outlook for funds in 2022. So on the next slide, you'll see our agenda. So we're going to go through first an overview and an outlook for funds. Next, we'll go into the investment fund debt methodology. So we'll give an overview of the key steps, and then we'll dig more deeply into our asset analysis, fund manager review and assessment, and transaction and legal structure. Finally, we'll say a few words about surveillance and ESG considerations, and then we'll take questions from folks after that. So in terms of an overview of funds, so funds are investment vehicles that are offered to investors in a broad variety of forms. For example, they can be either categorized as closed-end or open-ended funds. Open-ended funds are exposed to market value risk to satisfy ongoing capital infusion and redemptions. And closed-end funds are less exposed to market value risk because of that lack of ongoing redemptions that are permitted. The DBRS Morningstar investment fund debt methodology, we focus on closed-end funds. So fund investments, they share characteristics with securitizations and non-bank financial companies. So fund debt is repaid typically only from the cash flows from the underlying portfolios, similar to securitizations. However, fund managers have a pretty wide latitude to make investment decisions for those funds, like non-bank financial enterprises. As a result, not surprisingly, the tools that we use to analyze fund debt borrow from both securitization and non-bank financial analytical techniques. Because fund debt is repaid primarily from asset cash flows, its asset analysis is similar to structured finance. But since funds lack the specific parameterization that we might see in securitizations, such as collateral quality tests or concentration limitations we might see in corporate securitizations like CLOs, the asset analysis really requires a marriage between an analysis of the fund manager and their discretionary investment capability to determine stress portfolios that would be appropriate for the asset analysis to arrive at a particular rating level. So one way that DBRS Morningstar thinks about these types of analysis and where they kind of fit together is we think about a continuum of rating analysis techniques. So on one side, there's corporate analysis where you have fully discretionary corporate enterprises that can change strategy, have employees, and can fund and not fund themselves as they please. And on the other end of the spectrum is static securitizations, where there's very specific assets that have a very specific funding structure that doesn't change. So within the spectrum, closer to the static portfolio analysis, there's CLO analysis, which involves some analysis on what changes might occur in a portfolio in order for us to do analysis. And on the corporate side, business development companies, for example, are one step closer to securitizations. They have a specific company with a specific purpose, but they still have free reign to design their funding strategies, have employees, et cetera. So in the middle of these two different techniques, almost right in the middle is funds, because there is a fair amount of discretion, but not infinite discretion, about how a fund manager might invest its money. And it has discretion on how it might fund and lever itself up to a limit, but the cash flows really come specifically from a particular asset class. So thinking about these types of techniques in a continuum, the fund rating methodology, or the investment fund debt rating methodology, thinks about techniques that come from both the securitization side as well as the fund manager side. So our methodology, again, for rating these types of investment fund debt is called the global methodology for rating secured debt issued by funds. It's a global methodology, so it can apply to assets in the US or in other jurisdictions, and it could be useful for investors in the US as well as outside of the US. The methodology focuses itself on direct lending funds that invest in middle market loans. But the methodology can be used for essentially any corporate asset class. The methodology is used to determine a corporate rating. So unlike structured finance methodologies, it doesn't result in a structured finance rating. DBRS Morningstar has determined that the combination of these two techniques, given the preponderance, or at least 50% of the methodology is related to fund managers, that discretion warrants a corporate rating for us. So the types of ratings that we determine when we apply our methodology are corporate long-term ratings. So this methodology can be used for really, like I said, any kind of corporate debt, because the techniques for analyzing direct lending and any other corporate debt are very similar. So we've looked at this methodology thinking about direct lending, middle market loans, broadly syndicated loans, high yield bonds. Corporate private placement is also an asset class we could consider here when we're applying our current methodology. The methodology is also applicable to a broad variety of structures. So the types of structures that we've seen and the types of structures that we can analyze include debt or secured debt that's issued directly by a fund, debt that's issued by a feeder to a fund. So that could be essentially a repackaging of an LP interest from a fund in another fund or in a special purpose SPV. Debt issued by funds in early ramp-up stages are also things that we could analyze under this methodology. DBRS Morningstar on the CLO analysis side has a particular expertise looking at early ramp-up stage securitizations on the securitization end of the spectrum. There are not identical but related techniques that we use to look at funds that might be in early stages of ramp-up under the investment fund debt methodology. Finally, related also, but using other techniques, we have been able to apply this methodology in concert with other methodologies to rate debt issued by perpetual facilities. As analysts, the common challenges we have when applying the investment fund debt methodology include things that introduce risks that we might not be able to analyze under this methodology. So funds that have other asset-based leverage facilities are potentially analyzable depending on their format. So if a fund has an asset-based loan that's senior to the debt that we're analyzing, we have tools in the securitization toolkit to be able to look at that. I mean, essentially what we would be rating is mezzanine debt. But we do have to be able to at least analyze. We don't have to rate, but we do have to be able to analyze the debt that's senior to that. If that debt is more shorter term or total return swap related or has market value elements in it, that then we might not be able to analyze it, because things that introduce market value or liquidation risk are not things that we have a methodology to analyze. Funds that have non-asset-based leverage facilities like subscription loans or capital calls are things we can analyze under this methodology. So non-asset-based subscription loans, which essentially advance cash on LP investors' future investments, can be analyzed thinking about the potential uses of that facility, the credit quality of the underlying investors, and all of those things can be considered, because they might have a secondary lien or a tertiary lien on the underlying assets, but they don't have a direct asset security or an asset lien that we would consider in the same way as a typical asset-based loan. Funds with redemptions, so funds that are closed-end funds that have some redemptions, or open-ended funds, can be more challenging, again, because of the market value element. There are some limited redemptions that we are able to analyze potentially, so it does depend a bit on a case-by-case basis, but a more typical closed-ended fund would be more challenging for us under this methodology. Debt that has a short-dated maturity also might be challenging to us, because the liquidation value of the underlying asset might be more critical to our analysis than its potential default and loss severity. So for a fund that's only looking to be repaid by cash flows from the underlying assets, and not, for example, like other more fulsome enterprises like BDCs that might be able to issue more debt or take on other strategies to repay debt, the shorter debt maturities could be a challenge, along with other features that might introduce liquidation risk. With that, Lisa, maybe I'll turn it over to you to chat a bit about our funds outlook.
Sure. Thanks, Jerry. When looking ahead into 2022, we have a few thoughts on the rising rate and inflationary environment, as well as fundraising activity, fund size, and the experience of fund managers. We'd also note that COVID-related uncertainties continue to hang over any outlook. The rising rate environment should have minimal impact on direct lending funds in our rated universe over the coming year. These funds hold portfolios of floating rate loans. While over time, rising rates could drive higher loan defaults with increasing interest payments, near term, fund returns should be immune to the impact of rising rates, as many loans and direct lending funds have interest rate floors. With interest rates at historical lows, this means that the investment portfolio loans are at the floor and will not be impacted by rate increases until the floor is reached. We expect fundraising over the coming year to continue to be strong. Private capital funds have raised over $1 billion annually in each of the last 5 years, driven by strong investor demand and the hunt for yield. We expect for 2022 that this level of fundraising will continue. Furthermore, each of these funds continues to increase in size. While private capital funds have almost doubled in size on average since 2010, this remains a smaller asset class than private equity funds, which continue to dominate the fundraising landscape. For comparison, private capital funds averaged $600 million in size in 2021, while private equity fund sizes averaged close to $1 billion through 2021 per PitchBook data. Private equity fund size is skewed by the increasing number of private equity mega funds, which are vehicles worth more than $5 billion each. These vehicles have reached record levels and account for nearly half of all private equity capital raised. Lastly, we think that experience matters, and this will be further demonstrated in 2022. Data shows that the lion's share of capital is raised by experienced fund managers with strong track records. In fact, about 70% to 80% of capital raised is with fund managers that have raised 3 or more funds. We expect these experienced fund managers to continue to scale and expand. Moving on to slide 6. We take 4 key analytical steps to determine the rating of debt issuance from a direct lending fund, including asset analysis, fund manager review, transaction structure review, and legal review. Our methodology prescribes that we start with an asset analysis, which considers the investment portfolio's credit risk diversity, over-collateralization, and fixed charge coverage. Various considerations and scenarios are incorporated here, as funds could be in various stages of a fund life cycle. In ramp-up stage, fund investments are being made and capital is being called from investors. Funds could be in a revolving or reinvestment period when loans could be repaid and capital is being recycled into new investments. And funds could be in an amortization or wind down period while loans are being repaid and fund investments are declining. Throughout the timeline of a fund life, the fund could have different levels of diversity, but should maintain a consistent level of credit risk and a minimum level of over-collateralization. While our analysis is typically conducted using expectations for a fully ramped fund, we also consider the diversity of investments during ramp-up and rundown periods when running our scenario analysis. In tandem with the asset analysis, we conduct a fund manager review and assessment. This involves assigning a private or public rating or assigning an internal assessment to the fund manager using our framework for analyzing asset managers. This assessment helps us to make certain assumptions and expectations that are used in our modeling to drive the asset analysis. This also provides comfort that the fund manager will proceed on a go-forward basis with a strategy as anticipated. We also review the transaction structure, covenants, and applicable regulations, which could impact the final debt rating, particularly if we determine there's a level of debt subordination that needs to be considered in the rating. Finally, but also done in tandem, we conduct a legal and documentation review with internal and/or external legal counsel. And with that, I'll turn it to Jerry to talk about asset analysis in more detail.
Great. Thanks, Lisa. So when we conduct our asset analysis, and I'll focus on corporate assets and direct lending since that's the focus of our published methodology, there are 4 key areas that we look at. And the first is assessing the credit risk of individual investments that are in the portfolio, the portfolio's diversity, the asset coverage ratio that risk implies, and the ability of the fund to service its debt and other costs on an ongoing basis. So that's an analysis of a fixed charge coverage ratio. So in terms of assessing credit risk of individual investments, because the repayment of fund debt is focused on the cash flows that are received from the underlying assets that a fund manager invests in, we need to form a view on the stressed portfolio default rates based on the expected composition of the portfolio. So that will come from our expected default probabilities on the underlying issuers. Because we don't have as precise a group of collateral quality tests and other covenants, concentration limitations, et cetera, or even advanced eligibility criteria, typically, then there's some qualitative as well as quantitative assumption that goes into how we form that risky portfolio. But in terms of the underlying credit risk itself, from a default probability perspective, because these portfolios tend to be not granular, then looking at individual default probabilities is meaningful for the analysis. DBRS Morningstar looks to DBRS Morningstar credit estimates, DBRS Morningstar private ratings, or public ratings from really most any rating agency, but something that we would have access to on an ongoing basis in order to form a view on the portfolio's stress portfolio default rates. So it's possible for DBRS Morningstar to rely on historical portfolio composition and individual default probabilities from prior comparable funds if DBRS Morningstar credit estimates and or DBRS Morningstar private ratings or public ratings are available in those comparable funds. If that information isn't available, then DBRS Morningstar will rely on a combination of fund manager assessment and DBRS Morningstar credit estimates or private ratings determined on an ongoing basis for the portfolio as it ramps up. Unlike credit risk or default probabilities on individual obligors, much like our CLO analysis, our recovery rate analysis is based on average recovery rates. So we don't conduct an individual recovery rating or recovery rating like analysis on each of the instruments. We look to our assumptions in our CLO methodology for instruments that fall into particular seniority categories, like senior secured loans, unsecured bonds, mezzanine, subordinated debt, that sort of thing. In terms of diversity is an important component as well, and we'll look at Herfindahl scores or a diversity score calculation based on proposed portfolios, or if we could look at comparable funds, we can use that in our analysis when we're developing our various stress portfolios that we'll use in our scenario analysis. Within the public methodology, the illustrative tables that we have for asset coverage ratios, which is our next topic, those actually have an X and Y axis based on an average credit quality for the portfolio, as well as diversity and a rating level. So what's an asset coverage ratio? An asset coverage ratio is essentially the amount of over collateralization that is required given a portfolio's risk. So the ranges are provided for these sample tables essentially in our public methodology. And other ACR scenarios can be derived on a case-by-case basis. So we'll see on the next slide some examples of the ACR ranges, but we'll typically start with these ranges in the illustrative tables, and in the analysis that we might do on a case-by-case basis, we might start at the midpoint of an ACR range. And the final ACR range that we would determine would be applicable for a particular rating can be affected by a variety of factors. So they could be affected by the individual credit risk of the proposed portfolio or comparable portfolios in certain cases. It could be impacted by diversity, could be impacted by the seniority of the underlying assets. It could even be impacted by other sort of concentration considerations or jurisdictional issues as well, if there's a variety of jurisdictions. So we typically run through scenario analysis based on a particular fund to arrive at an expected portfolio composition that we would use to arrive at an asset coverage ratio. And then finally, in terms of ability of the fund to service its ongoing obligations, we'll look to a minimum 1.5 times fixed charge coverage ratio for an investment grade rating. We'll also run a variety of other analyses if there are other costs that would impact the likelihood that the debt would be repaid. So on this page, we dove a little bit deeper, and we've got here for folks to see the sample asset coverage ratio tables that we have in the underlying methodology. So we have 3 different scenarios here. We have a baseline diversity scenario that which essentially means when the portfolio is ramped up, there would be approximately 25 to 30 investments across 15 different industries. I'm thinking, Lisa, on this slide, actually, that the baseline and the diversity look maybe a little too close together there. So one of those might actually be wrong on the slide. So in any case, this scenario here is probably more of our high diversity scenario. The low diversity scenario is approximately 8 to 15 different investments and a minimum of 6 to 8 different industries. So if you take a look at our public methodology, you'll see because we have this publicly disclosed, you'll see the appropriate description of the baseline diversity scenario. If we wanted to take just a short example on how the asset coverage ratio, or what exactly a specific asset coverage ratio means, if you just look at the very first number in the top left box, what does a 134% asset coverage ratio really mean? It means that for $100 of assets, we would require $34 of additional collateral. So that roughly means 25% subordination or a 75% advance rate. If you look down to the high diversity box, maybe a more typical scenario that we would see, rather than double B assets requesting a double A rating, which is essentially part of that range that I just used. But if you look at an average credit quality of B flat in the high diversity scenario, where there's more than 30 investments, and the requested rating on the x-axis, if you have the requested rating of triple B, and you take a midpoint of that, which is 100%, then that would actually mean 29% subordination and a 71% advance rate. So in our analysis, in summary, for the assets, we're going to combine a quantitative analysis based on information we're able to gather about what the expected portfolio is going to be, either from comparable existing funds or from a fund manager, or combining elements of our fund manager assessment, thinking about what the portfolio manager might invest in going forward. And we use that to arrive at an asset coverage ratio based on the quality of the fund manager, the quality of their platform, the likelihood that they would abide by a particular scenario. And as a useful guide for folks, these 3 tables can be used to essentially take a look at where we might come out on a particular fund. What we'll do typically in practice, because portfolios might not precisely fit all of the qualifications that we use to derive these tables themselves, but as part of our feasibility analysis and part of our rating process, we'll look at what the portfolio would actually be expected to ramp into. We develop our own stress portfolios and stress portfolio default rates, then arrive at an asset coverage ratio through our scenario analysis that would be specific to a proposed transaction. So with that, Lisa, maybe I'll turn it over to you for a discussion on fund manager review.
Great, thanks. So we assess the fund manager's credit profile and performance through a full review and assessment using DBRS Morningstar's framework for analyzing asset managers. For this analysis, we look at 5 broad categories that we call building blocks, which include franchise strength, earnings power, risk management, funding and liquidity, and capitalization. Each building block has up to 6 subfactors, both quantitative and qualitative in nature, that are assessed within a methodology grid. These subfactors receive scores, which are then aggregated to a private or public rating. We can also assess the fund manager via an internal assessment, which eliminates the methodology grids and is not considered a rating, but the 5 building block approach is used for the analysis. Irrespective of whether we assign a private rating, public rating, or internal assessment to the fund manager, the end goal is to assess a fund manager's ability to successfully carry out its strategic goals and initiatives using historical information and performance as a guide. We specifically focus on a fund manager's credit profile, historical performance of the fund or predecessor funds, and fund returns as compared to index benchmarks or other market data. We view a fund manager that has strong performance in the asset class or investment strategy over numerous cycles favorably, which could allow us to apply a lower asset coverage ratio, which implies a higher level of leverage for a given rating level, reflecting the benefit of the fund manager's track record. Can we go to the next slide? And on our transaction and legal review, this is a critical part of the rating process because every transaction is different. We have reviewed a large number of transactions since publishing this methodology, and each one is unique. While there are some similarities, there is limited standardization. Debt issued by funds is a relatively new and quickly expanding market sector. Because of this, there's a wide variety in the types of structures that we see. We want to be sure to dot our I's and cross our T's, as do the fund managers that we're working with. When reviewing the transaction structure and covenants, we look at various aspects of the transaction, including form of debt and structure, other leverage. For example, if there's an ability to incur additional debt, we incorporate this into our scenario analysis when determining the asset coverage ratio. The length of the ramp-up period, the revolving or reinvestment period, and the amortization period, investment eligibility criteria, advance rate or asset coverage ratio, and any applicable covenants. Some transactions include over-collateralization triggers or minimum diversity triggers. These triggers result in redirecting interest collections or principal payments to pay down the debt. Legal and documentation review is performed by internal and/or external counsel with a detailed review of core fund documents, the debt agreements, and applicable regulations. We also assess counterparty risk, which comes in the form of subscription lines or other counterparty exposures. And with that, Jerry, I'll turn it back to you.
Great, thanks, Lisa. So maybe before we hop into surveillance and ESG considerations, it's worth making one last comment here about how we think about the fund methodology and the investment debt raised by funds. Because funds don't have the specificity of structured finance ratings, but they have the flexibility afforded a more typical fund manager structure, there are trade-offs in how we think about the analysis. So for transactions like securitizations that are more asset specific, so there's greater certainty around what the stressed portfolio will ultimately be or how that will change over time. DBRS Morningstar might typically be able to apply a higher rating. So, not surprisingly, in structured finance ratings, often we're asked to assign AAA ratings. Often the leverage sought is higher than we might see in the fund, in the underfund structures or debt issued by funds. And that trade-off to us makes sense and is reflected in our underlying methodology. So that flexibility is also afforded in the analysis that we might be able to do for funds if there are very specific covenants or more clear concentration limitations, those aspects that might be closer to a securitization could be considered in the analysis, but ultimately, it's more likely that you would be able to achieve a higher rating from a transaction with an exclusive pledge of assets and a very specific, rigid set of guidelines around what could be invested in a portfolio now and going forward. So with that, if we turn to surveillance and ESG considerations on slide 11, after we assign a rating, then we will surveil and monitor the rating. It's a long-term corporate rating, so we will monitor it in accordance with the methodology, and the rating will remain a long-term corporate rating. So if the funds or its investments change, then that might impact the rating on the investment fund debt. So we will monitor the investment manager's credit quality and our own assessment of their performance, and we'll update our internal assessment on their credit quality on an annual basis. We'll continue to monitor how an investment manager is abiding with the investment strategy that we assumed when we first assigned the rating. If we see deviations in that, that might be a candidate for a change in a rating. Much like in a corporate rating, if a company changes its leverage strategy or changes its underlying business strategy, we would adjust a rating potentially to account for those changes in potential cash flows. We'd also continue to, or we would review quarterly and annual financial statements for changes in any debt on the fund, changes in strategy or investors related to a subscription loan, and any changes in the debt service coverage ratio. So since our surveillance is ongoing, we monitor long-term corporate ratings. DBRS Morningstar requires periodic reporting on the collateral in the fund as well. So this might include details on the underlying fund's investments, including information on the underlying investments themselves, as well as audited financials for the fund, if those are available, information on how ramp up is progressing or wind down is progressing, and financial information so that we can determine individual asset default probabilities for new investments in the fund. DBRS Morningstar also requires notification for amendments and any breaches of any financial covenants that the fund has made. In terms of ESG considerations, ESG factors may affect a credit rating, and it may affect a credit-related analysis. So in order to assess that, we apply the DBRS Morningstar criteria, the approach to ESG risk factors in credit ratings. So we assess those ESG factors within the building blocks of the fund manager assessment, and we also analyze them in light of the underlying portfolio of corporate credit. Because the underlying portfolio is diversified, our view on ESG credit risk is it's really only if there are particular concentrations in industries or in regions or in business strategies of the underlying collateral. That's the place where ESG risk might appear in corporate portfolios. But in any case, we'll allow the criteria to flow through from both the fund manager assessment as well as the underlying collateral, the transaction structure, and legal documentation. So that concludes our presentation here, which is an introduction to our methodology and a fund overview. I see we have a couple of questions, but please feel free to raise your hand in the question box and let us know a question. So I have two questions here. So the first is, have you looked at funds with infrastructure debt as the underlying? And a follow-on question to that is also, would this methodology apply to issuing multiple debt tranches? So it's actually a great question, because right now our methodology is focused primarily on direct lending, and that lens could be used to look at corporate assets. But it's certainly conceivable that there could be other versions of this methodology where the underlying assets were in corporate assets, but there were something else that we could analyze, that we could have an opinion on those types of funds. So as we develop those techniques, we'll publish new or updates to our methodology in order to reflect the different types of assets that we can analyze. But as an aside, we don't have a methodology to analyze portfolios of infrastructure debt right now. We do have the ability to look at infrastructure debt on a case-by-case basis. So I would say that we don't have a methodology to look at a fund rating with infrastructure debt at this time. And then the second part of that question is, would this methodology apply to issuing multiple debt tranches? The short answer is yes. As long as we can analyze the other debt tranches, then having multiple debt tranches is feasible. So even if one of those debt tranches is not, we aren't asked to rate that tranche, but we are able to analyze that tranche. If it's more senior, then we might be able to analyze multiple debt tranches. But yes, in any case, we can look at multiple debt tranches. So the next question I have here is, what's your view of hybrid NAV and capital call facilities, and how would you rate them? So I guess there's two, I have two comments on this. So hybrid NAV and capital call facilities themselves, we might be able to rate using a combination of our CLO methodology and our subscription loan methodology. So providing a rating on that debt itself might actually be something that we can analyze. So we might be able to either rate that tranche in and of itself, or we might be able to consider that in a multiple debt tranche scenario where one of the debt tranches has some asset-based lending or NAV-based lending as part of its structure. Things can be a little tricky sometimes with the NAV component of hybrid structures. If there is a market value component in there, then that might be trickier to analyze. But we should, in spirit, if the analysis is truly derived by default and loss severity, we should be able to analyze a hybrid NAV and capital call facility. All right, the next question I have is for Lisa. So Lisa, how would we differentiate amongst different collateral managers or different fund managers?
Yeah, so in my prepared remarks, I talked a bit about strong fund managers. We also could be presented opportunities where we have to assess a weaker fund manager. I'd say that for a moderate fund manager, kind of in the middle, maybe, or with less of a track record or experience, we may need to have a higher asset coverage ratio within the fund for a certain rating level. For weaker fund managers, we may not even have the ability to assign a rating, as we would be challenged to make assumptions and expectations within our modeling without the degree of predictability that's linked to a stronger fund manager.
Great. Thanks, Lisa. All right, so this looks like the end of the questions. I would encourage anyone who has any further questions about the analysis to reach out to either Lisa or me. If you have any questions unrelated to the analysis, please feel free to reach out to our business development folks. But thank you very much for attending the first session in our 2022 Credit Outlook series. Thanks for listening to us talk about investment fund debt and our methodology. Have a great afternoon.